We are midway through 2021 and it is a good time to take a look at what's going on in the stock market, especially in the long term for some of the more famous index funds. If we take a look in 2008, there was a crash, and after that crash, every single of those index funds such as S&P 500 and Dow Jones and Russell 2000 have been going for sky high prices. So everything is at an all-time high right now, with PE ratios tripling for most of those index funds. So a good question to ask yourself right now: what is the best way to invest when everything is so high in price? When I'm struggling to find answers to some of those questions, I refer back to one of the best investors of all time, Warren Buffett. So let's see what he has to say about those market conditions.
He says, if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stock?
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who will stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is just too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, well, then making a deal with us, because somebody else would come along with using other people's money. It's, you know, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
From the answer from 2021 annual meeting in the Berkshire Hathaway, you can see that Warren Buffett's strategy still has not changed. It is to find stocks that are below their intrinsic value and therefore make a good investment that can bring fruit over the next couple of years or next decades. But how can you find those stocks when everything is at a sky high price? If we take a look at S&P 500 PE ratio, it is currently at 45, which is 3 times as high as the average of 15 that it usually has. So when some of those companies are reaching very high prices, Warren Buffett doesn't actually focus on them because they are priced at over their intrinsic value. Only focuses on businesses that are worth a while in the current market condition.
Yeah, just raise your hand and the monitor will supply the microphone.
Thank you. Howard Winston from Cincinnati, Ohio. One question. Are you concerned about the rising valuations on the NASDAQ market, where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they trade at 10 times revenues or more, 30 times revenues, instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that, because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced, and phony stock promotions, and the gullible being led into to believe in things that just can't come true. So that's always gone on. It always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. we tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. It really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years. But it's very tough to make money being short them. Although we tried a few times way back. We don't look at indicia from stocks in general, or from PEs or price sales ratios, or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola? The 8% we own of Coca-Cola, the 11% of Gillette. If they said we're just going to delist the stock and we're never going, we'll open it again in 20 years. It's fine with us, And if it goes down on the news, we'll buy more of it. So we care about what the business does.
So if we take a look all the way back to 2008, we can see that index funds such as S&P 500 were at an all-time high as well. They were reaching sky-high prices of $1,500 a share, and soon after they fell as far as $700. So what did Warren Buffett do in that period? He was struggling to actually find deals for companies that were trading below their intrinsic value. So what he did instead, he put a lot of money from Berkshire Hathaway into treasury bonds, which is pretty much similar to holding cash. And then when opportunity arose back in 2009, he deployed most of that cash. He was holding $45 billion in treasury bonds, and then when the opportunity arose in 2009, he was only holding $25 billion in cash. So he had a lot of money ready to invest. And that's what you should be doing as well, having 10 to 20% of your portfolio as a cash in assets. So when the stock crash does come, you are actually ready to buy some more stocks when other people are being fearful and selling their stocks. Also, in the interview, he said that when he was struggling to find stocks to buy, he tried shorting, but that cannot be a good idea when it comes to his strategy, because you never know what the market is going to do. It is very hard to predict the market, and a great example of that in the current times is shorting Tesla. Many people tried to short Tesla last year, many people tried shorting Tesla this year, because it looks like a good strategy at first. Tesla is not making that much money, but they are trading at a very high price. The price to earning ratio right now is about 660. So if you're logically thinking, maybe they should be going down. That's not how the stock market works. The stock market does not care about the intrinsic value of the business. So a business like Tesla can be trading at a PE ratio of 660, and there's no guarantee that it will go down. So shorting it might look like a good logical idea, but then in reality it might not turn out to be so good after all. So that is why Warren Buffett is not shorting anymore. He rather hold cash and then wait for the good opportunity to invest into some stocks that he believes in, that he finds are trading below intrinsic value. And that's really it for this video. So just to summarize, you should be holding, according to Warren Buffett, some of your assets in cash ready to deploy when there is a good opportunity in the market to do so. If you guys enjoyed the video, make sure to give it a thumbs up, subscribe to the channel. There will be a link down in the description if you want to open your stock portfolio in the UK, where you can get a free share up to £200, and I will see you in the next one.